Rather than paying for 100 shares of the stock or ETF upfront, equity option buyers and sellers pay or collect premiums in return for the rights and obligations we have already discussed. As the premium is simply the cost of the option contract, let's take a closer look as to how options are priced and the market forces behind their value. We have previously covered buying and selling options and the rights and obligations of option holders and writers, but what will an option actually cost in the marketplace? The amount of money you pay for an option contract or the amount you receive from its sale is called the premium or price and is disseminated by the exchanges in dollars and cents per underlying share. Let's look at a few examples by clicking on each of the tabs below. Just like most goods and services, you can only buy something for the price at which a seller is willing to sell. With options, this selling price is known as the ask price or offer. In this example, the ask price is $2.50, and as each contract typically represents the right or obligation to buy or sell 100 shares of stock, the option price is often multiplied by 100 to reflect the real cost of the contract. In other words, a $2.50 ask price equates to $250 per contract. If you were to buy 10 contracts, the total cost would be $2,500 or $250 times 10. Currently, option buyers must pay for the contract in full upon executing the trade, as they cannot be margined in the way that stock purchases might be margined. Once you purchase an option, this premium belongs to the seller and is in no way refundable, whether you exercise the contract or not. However, this premium also represents the maximum loss or maximum risk to the buyer. In other words, buyers cannot lose more than they put into the trade. More on that later. Just as buyers can only purchase a contract at a price at which the seller is willing to sell, option writers can only sell a contract at a price at which buyers are willing to pay. This price is known as the bid. Similar to the ask price or offer, the bid price is quoted on a per-share basis of 100. So in this example, with a bid of $3.75, a single option contract sold would represent an amount of $375. Option sellers bear the brunt of the risk in the option trade, as they are obligated to fulfill the terms of the contract regardless of where the underlying shares might be trading as the contract reaches maturity. For this reason and others, the premium paid to the seller is non-refundable. It is the seller's to keep regardless of the outcome of the trade. However, the premium collected also represents the maximum profit for the seller, meaning a seller cannot make more than the premium they receive. When it comes to determining the value of an option, we need to remember the most basic and fundamental principle of economics. Like most goods and services, pricing in the options market is simply a function of supply and demand. Increased demand from buyers wanting to purchase a contract logically will lead to higher prices as they compete against each other to own the contract. Conversely, an increased supply of sellers looking to liquidate a position will logically lead to lower option prices as traders compete to exit their positions. Regardless, aside from simple supply and demand, the price of the underlying asset is perhaps the biggest influence in the price of the option, and logically so. It stands to reason that a call contract giving the investor the right to buy shares for $50 would command a higher price versus the right to buy shares for $55. That being said, while there are several other factors at play in determining the value of the option, no other factor has a more direct effect than the underlying share price. The general rule of thumb is that as share prices increase, call option prices increase and put option prices decrease. And as share prices decrease, call premiums fall while put premiums rise. The amount by which option prices increase or decrease is determined by other factors, but what is important here is that stock prices and call premiums have a direct positive correlation, while stock prices and puts have a negative one. Stock goes up, calls go up. Stock goes up, puts go down. Conversely, as share prices fall, so do call premiums, while put premiums typically increase in value. Keep in mind that this is simply a general rule of thumb, and market influences such as supply and demand, as well as other factors, can affect this relationship. A key concept for those learning about options is differentiating premium and the exercise or strike price. The premium is the price you pay for a contract in a purchase or collect in a sale, whereas the strike price is the price at which you have the right or obligation to buy or sell shares of stock. As such, the premium does not affect the exercise price of the option. In other words, no matter what you pay or receive for the standard contract, you will still be buying or selling 100 shares of the underlying stock at the strike price when and if the option is exercised and/or an assignment is made. However, as option premium directly affects profit and loss, or what's commonly referred to as P&L, let's take a look at how to calculate P&L from a buyer's and seller's perspective by clicking on the examples below. How do buyers profit from an option transaction? Remember the adage, buy low, sell high? When buyers purchase any asset and then sell it, this saying applies, of course. If you are similar to more than 70% of option traders and close out your contract ahead of expiration, how do you determine if you have made a profit or not? In this example, the investor purchases a contract for $2.50. Let's assume this is a call contract and that sometime later the price of the underlying shares increases. Remember from the earlier lesson that as share prices increase, so does the value of the call contract. Now, a few weeks pass by, and as a result of positive news pertaining to the underlying stock, share prices increase, which leads to an increase in the value of the option, now trading for $4 in the open market. One possible action for the call holder would be to simply sell the contract back to the market to close the position at the $4 price and retain the difference of $1.50 as profit. In this scenario, the buyer paid $2.50 and sold for $4. The $1.50 difference, or $150, would be taken as profit, minus any commissions or fees charged by the broker. On the other hand, if market news causes share prices to decline and thus the price of call options to drop, say to $1.50 down from the $2.50 purchase price, the buyer is faced with a choice: retain the position and hope for things to turn around, or sell the contract back to close out and limit potential losses. If closing out the position, the $1.50 selling price would be deducted from the $2.50 purchase price, resulting in a loss of $1 or $100. From the option seller's perspective, the buy low, sell high adage takes on a reverse twist: sell high and buy low. If a seller were to write an option for $5, the total premium they would receive would be $500. This cash would then go into their brokerage account. If they were to buy it back or close it out for $2, the premium they would pay would be $200. This is cash that would be transferred out of their brokerage account. The net of the two transactions would be $300, the $500 credit upon the sale and the $200 debit upon buyback. This would be taken as profit. On the other hand, if the writer sold the contract to open at $5 and brought it back to close for $7.50, the loss would be the difference of the two transactions of $2.50 per contract, or $250. Of course, if the short option were to get assigned, this profit or loss scenario may look completely different. As such, it is imperative that option sellers be completely familiar with the potential risks of assignment and how it can affect their profitability. When discussing the value of options, we refer to the moneyness of the contract, meaning, is the option considered to be in, at, or out of the money? The moneyness of the contract refers to the exercise price in relation to the current share price of the underlying. And it's important for investors to be familiar with not only the terms, but the risks associated with each. These are simple concepts when you understand the terms of call and put contracts. Why would an option contract be considered in the money? The term implies that there would be some benefit in exercising such an option at that moment. An option can be considered in the money because the owner who exercises it would pay or receive a better price than by actually buying or selling shares outright in the stock market at the time. The definition of each is noted on the call and put tabs. And watch the video below for another look.
What's in and what's out? Well, we have three new terms. We have in the money, out of the money, and at the money. When the strike price is below the current stock price, that's in the money for a call option. The call holder has a right to buy that stock at a price which is less than it would currently cost in the stock market. For puts, when the strike price is above the current stock price, that's an in the money put. The holder of this put has a right to sell the stock at a price which is greater than would currently be received in the stock market. Let's take a quick example. If you have a stock that's trading at $70 per share and you have a strike price of $50 and you own one of these $50 calls, Remember, the stock is currently trading at $70. That's in the money by $20. Out of the money for a call is when the strike price is above the current stock price. So if you have an option, a $70 call option, when the stock is trading at $50, that option is said to be out of the money. Out of the money for a put is when the strike price is below the current stock price. So if you have an option, a $50 put option, when the stock is trading at $70, that option is said to be out of the money. A call or a put is at the money when its strike price is exactly the same as the current stock price. Let's take a quick quiz to make sure you understand the concepts. If a stock is trading at $100 and the call has a strike price of $90, how much is it in the money? If you chose $10, you're correct.
Now that the basic concept of moneyness has been reviewed, let's take a closer look as to why it is an important concept to know by clicking on each tab. In the money calls. With stock trading $65, it makes sense that any of the strikes below $65 would be deemed in the money, as the call holder could exercise the contract and take delivery of shares below the current market price. In this example, any of the $60 strikes, regardless of expiration, are considered in the money. Another item to note is that the $60 strike commands a higher premium than the $65 or $70 strike. The deeper the call contract is in the money, the more expensive it becomes. This is important to note in that though the call requires more capital upfront to purchase, the likelihood of the contract expiring in the money and with exercise value is greater than with at the money or out of the money strike call options. At the money calls. At the money options are a bit easier to grasp, as the definition is simply that the strike price and the stock price are equal. In the real world, however, this is rarely the case, as the probability of shares closing at exactly $65 is unlikely. Therefore, the accepted use of the term at the money describes whichever strike may be nearest the share price, though they may not be a penny for penny or even dollar for dollar match. What is interesting, however, is that options volume is typically greatest around the at-the-money strikes, and it is also here that we see the biggest influence of many of the Greeks, which are theoretical pricing inputs that affect pricing movements of the option and will be discussed in detail in subsequent courses. Out-of-the-money calls. Out-of-the-money call contracts occur when the strike price is above the current share price, and as it typically wouldn't make financial sense to exercise the contract and buy shares above where they are currently trading, you might be asking yourself why someone would ever buy an out-of-the-money call. For one thing, option premiums for out-of-the-money calls and puts are typically far less than in-the-money options of the same expiration, thus requiring less upfront capital and therefore less dollars at risk. Remember, when it comes to buying options, you can only lose as much as you put into it. However, that does not mean that buying out-of-the-money calls are less risky than their in-the-money counterparts. In fact, it might just be the opposite. In order for our $70 out-of-the-money call to have positive value at expiration, shares will need to close above $70, $5 above where they are trading today. Whereas the in-the-money $60 call already has positive value and therefore inherent worth. In-the-money puts. As with most things options related, the puts behave in an opposite manner than calls. In-the-money puts occur when the strike price is above the current share price, as it is economically advantageous to sell stock above its market price. In the example here, a holder of the $70 put, regardless of the month, has the right to exercise and sell shares, or put shares to another, at $70 when they are trading $65 on the open market. At-the-money puts. As with at-the-money calls, at-the-money put strikes are those nearest to the share price of the stock. In our example, the at-the-money $65 put is equal to the share price, and therefore, the long put holder would see no economic benefit in exercising. Selling shares at $65 by exercising would not be any different than simply selling those same shares at the same price in the open market. Out-of-the-money puts. Out-of-the-money puts have a strike price lower than the current share price of the stock. In this example, the put holder would be worse off economically by exercising and selling shares at $60 when they are trading $65 in the open market. However, just like out-of-the-money calls, buying out-of-the-money puts are not without their appeal. Many investors utilize out-of-the-money puts to protect their existing shares or overall portfolio in a popular strategy known as the protective put. An options premium consists of two components, intrinsic value and extrinsic value, commonly referred to as time value. The amount by which an option is currently in the money is called its intrinsic value. Equity options are generally worth and will generally trade for at least their intrinsic value. However, because options have a lifetime and the rights conveyed to their owners to buy or sell stock at the exercise price extend until the expiration date of the contract, options will generally trade for more than this amount. For sellers, much of their risk is based on the price of the stock come expiration. But if expiration is months or even years down the road and the future price of the underlying is hard to predict, sellers are able to command a higher premium for the increased level of risk with longer dated options. This extra premium, above that of the intrinsic component, is commonly known as time value. Click the examples below and then watch the video for a closer look. Based on a stock price of $67, we are able to establish that a $60 strike call is in the money, as its strike is below the share price. In fact, using simple math, we can see that the call is $7 in the money. However, in our example, the price of that contract in the open market is $9. Based on this, we can determine that the intrinsic value of the option is $7, which is the in-the-money amount, and therefore the remaining $2 is attributed to time value. When it comes to puts, we know the in-the-money amount to be the amount by which the strike exceeds the current share price, or $3 in this example. Any remaining premium in excess of the intrinsic value of $3 is deemed time value.
An option's premium is its total market price. It's the money paid by the option buyer and received by the seller. An option premium is composed of two parts, intrinsic value, if it has any, and time value. Intrinsic value is the option's in-the-money amount, if it has any. Time value is any premium amount in excess of intrinsic value. Therefore, only in-the-money calls and puts have intrinsic value. Please note that intrinsic value must be greater than or equal to 0. The premiums of at-the-money and out-of-the-money calls and puts consist only of time value. Let's say we have a stock that's currently priced at $55, and we have a $50 call option on that stock priced at $8. Since the stock price is $5 above the strike price, this call is in the money by $5. It is therefore said to have $5 of intrinsic value, its in the money amount. But the quoted premium amount is $8. The time value, in this case $3, is the premium amount in excess of the $5 intrinsic value. Generally, in the money options do not trade below intrinsic value.
So, what does time value represent? It reflects the amount of time you are purchasing or selling for your option position to become more profitable because of a favorable move in the underlying stock price. For a writer, it is clearly more risky to sell longer-dated options, as while it might be easy to predict the price of a stock 2 weeks from now, accurately predicting the price 2 years from now is much more difficult. As such, option writers will demand a higher premium in order to obligate themselves with higher risk. Logically then, for options with the same exercise price, the more time until expiration, the greater the time value component of an option's premium and the more expensive the contract. Or, more simply put, the saying of time is money directly applies here, as the longer the maturity, the more premium the option commands. Let's consider a couple of examples of in-the-money calls and puts. All of these options are currently in the money and have a fixed intrinsic value amount. As you can see by these hypothetical trading prices, the amount of time value increases with the amount of time until expiration. As previously discussed, only in-the-money options have intrinsic value. However, the prices at which they trade generally have both intrinsic value and time value components. But what about at-the-money or out-of-the-money option contracts? As they have no in-the-money amounts and therefore no intrinsic value, their premiums consist entirely of time value. As it is the time value portion of the total premium that increases with time, At the money and out of the money option premiums will also generally increase with increasing time until expiration. Another phenomenon involving time value is that as calls or puts become more in the money, the time value portion of its premium decreases relative to the total premium. This makes sense when you remember what time value represents: time for your long option to become more in the money and hopefully more profitable. As options become more in the money, the likelihood that they will expire in the money increases, rendering the time remaining until expiration less valuable. As this happens, the option's total premium should increase, but the proportionate amount of time value should decrease. The graphic below also illustrates this concept. Let's look at a typical option chain of all option prices for XYZ stock and observe some characteristics of premiums versus strike price versus time until expiration. Option chains like this are commonly found on many brokerage firms' trading platforms, and though the chain on your platform may look different, the data remains the same. Click each table to learn more. First, let's take a look at the calls. You can clearly see that as the strike price within a specific maturity increases above the share price of $67, the premiums get cheaper. This is because the options are moving further out of the money in relation to the share prices. So, as call strike prices increase, option premiums decrease. And as call strike prices decrease and move closer to or further in the money, option premiums increase. Puts work the same way as calls, though in reverse order. As puts move closer to or further in the money, the premiums increase, just as with calls. However, remember that puts are in the money when the strike price is above the share price, so the higher the put strike, the more expensive it becomes. Now that we have discussed the relationship between option premium and strike price, let's look at premium versus time. As we have recently mentioned, the saying "time is money" is never better illustrated than it is when it comes to options. And, as we have already learned, longer-dated options command higher premiums due to the increased risk option writers must accept when selling options. This general rule applies to both calls and puts. The option type is irrelevant, only time matters. That being said, is it better to trade shorter or longer-dated options? While the pros and cons of both are outside the scope of this course, it comes down to one of the most fundamental questions of option trading. What is my forecast for the stock? Or, to look at it another way, what do I think is going to happen and how long will it take? The answer to this, naturally, varies from investor to investor, but should always be at the forefront of your mind before making a trade. To see the effect of time on calls and puts, click on the tables below. As you can see, as time until expiration increases, so do option premiums for the same strikes. The idea is that sellers are generally obligating themselves to accept more risk as it is difficult to predict where a stock might be trading months or even years down the road. As such, sellers are able to command greater premiums in order to account for their greater risk. Time affects puts similarly in that as time until expiration increases, the options premium for puts increases as well. You can see that the December 70 strike put commands a much higher premium than the September put of the same strike due to increased risk on the part of the seller. Though we often refer to extrinsic value as time value, time is actually only one of the components that is used to determine the extrinsic value of the contract. Other inputs include the implied volatility of the option, as well as any future dividends or expected changes in interest rates, topics that will be discussed at length in subsequent courses. But we often refer to extrinsic value as time value, given that time plays such a major role. And since time is so important, it stands to reason that as time decreases and we move closer to the maturity date, the time component of the extrinsic value decreases as well. This phenomenon is known as time decay, and it affects both calls and puts equally. Let's consider the following scenarios to illustrate the concept by clicking on the boxes below. A May 60 strike call option is trading for $5.75. With shares trading $62.50, this call is in the money by $2.50 as the strike price of $60 is $2.50 less than the stock price. This in the money amount also represents the intrinsic value of the call. However, as the total premium is $5.75, the amount by which the total premium exceeds the in the money amount is the time value portion, or $3.25 in our example. Simple enough, right? Now let's take this example further in time to see the effect of time decay on our call option. Click back on the main slide. Now, let's assume that as expiration approaches, shares remain unchanged. As time is a major component of extrinsic value, less time, assuming other factors being constant, logically means less value. This chart helps illustrate the concept that as time goes by, the value of the contract decreases as we approach expiration. You will also notice that the slope of the time value line is not constant and straight, as one might expect. Remember that time value is simply the future opportunity for the contract to be in the money. As expiration nears, that future opportunity diminishes exponentially. When the contract expires, all time value will have decayed away, and the contract will be worth its intrinsic value only, if any. Remember, the passage of time is only one of many factors that affect an option's price. A change in one or several other factors could have overcome time decay in this case and may have resulted in a profitable scenario. For instance, had the price of stock in our previous example increased dramatically to $70 at May expiration, the intrinsic value of the $60 strike call would have been $10, considerably more than the $5.75 paid for the contract. On the other hand, had the price of stock dropped dramatically after the call's purchase, it would have become out of the money and possibly have no market value at all. In this case, the effect of time decay might seem insignificant. That being said, the investor might be asking, is time decay always a bad thing? And the answer is, it depends. While it is true that time decay will always work against option buyers, it is often a boon to sellers. Remember sell high, buy low? When investors are short option contracts, they want time decay. They want the total option premium to decrease to make a profit. In many different option strategies, investors can write or sell options in the hope that they will decrease in value. As stated earlier, there are other factors that affect an option's premium. The singular effect of a change in any of these factors may be good or bad for an options position, and the sum effect of the changes in some or all these factors may be good or bad. Option pricing is a dynamic process. The marketplace will account for all these factors as they change over time and price options accordingly. Let's take a moment to make sure that you have understood some of the concepts we have covered so far. Follow the instructions on the next few slides to complete the module. Please select the appropriate response below to the following question. Please select the appropriate response below to the following question. Thank you for taking the time